I joke about pinching pennies because at the end of the day, a penny saved is just a penny. But if we're talking about growing and compounding our money, then things are different. Because if you start with a penny today and you can double your money every single day for 30 days, after 30 days, that penny is going to turn into more than $5 million. The whole idea behind compound interest is you're going to invest some money today, this money is going to grow, and now you have your money working hard to make you money, and the money that your money made working hard to make you money. So it's almost like your money is having babies, and your money is just going to keep compounding and growing, which means you have more money working hard to make you money. Even if you're not investing your money in the traditional sense, you should hopefully still be earning this type of compound interest, because if you go to work every single day, you're compounding your knowledge and your skills. And so the longer you go to work, the more skills you're going to learn, and the more valuable you're going to be as an employee. That's why as you get older, your pay should hopefully go up too, because you're compounding your knowledge, you're compounding your skills, and now you're more valuable, which means you should be getting paid more money. It's the same concept with your money, except more money doesn't give you more skills, it just gives you more power. Like this $100 bill doesn't have more skills than this $20 bill does, it just has more power, because assuming that $1 will buy me a machine that's gonna make me a nickel, now with this $100 bill, I can buy 100 of those machines. With this $20 bill, I can only buy 20 of those machines. So I'm going to be able to earn more nickels with this $100 bill than this, just because I got more power with this piece of paper than this one. But this is where compounding becomes so powerful, because every dollar I earn will buy me another machine that makes me a nickel, and I need 20 nickels to earn a dollar. This $20 bill will get me 20 nickels, which will buy me one more nickel making machine. This $100 bill will earn me 100 nickels, which will buy me 5 more nickel making machines. So I'll be able to earn more nickels with this just because I got more buying power. The more dollars you have, the more dollars your money is going to be able to make. And the longer you let your money sit there and invest and compound, the more your money is going to be able to grow. That's why Albert Einstein calls compound interest the 8th wonder of the world, because now your money is working hard to earn you more money. And every time your money does that, you're going to have more money that you can send out to work hard and earn you more money. So it becomes a system, almost like this machine that's just working to produce you more money, and anytime you produce more money, you can buy another machine that's going to be working to produce you more money. You don't need a ton of money to start, but the longer you have, the more your money is going to be able to grow, which is why you're going to see the biggest returns towards the end of your compounding. Like even if you start with just 1 penny and you can double your money every single day, day 1 you have just a penny, and day 8 you have $1. By day 21, you have $10,000. Now your money is really starting to grow. And by day 30, you're gonna have over $5 million, and you started with just a penny. Now, I already know what you're thinking. But Jaspreet, if it was so easy for me to double a penny, I'd already be doing that right now. Now, I know it's not easy to double your money every single day, and that's not the goal, but you can do this over time. There's a couple of different strategies that you can follow to compound your money and really build your wealth over time. There's an active strategy and a passive way. I'm gonna be going over this, but before I do, I need you to do me a quick favor and compound that thumbs up button below. Actively compounding your money is literally what the word says it is. You are being active and you are buying something, selling it, and now you're using your profits to go buy something else. You see this all the time in real estate. You go out and you buy a $100,000 property, you renovate it, whatever, you fix it up, and you go sell this property for $150,000. Now instead of going and buying another $100,000 property, you go out and you buy a $150,000 property and you renovate it, and now you sell it for $225,000. And so slowly you are growing your money and compounding your money because you can do bigger deals. Now you can do 2 deals at one time. You can do $200,000 deals and hopefully sell both of these for $150,000 each. And now you're just compounding what you're doing. You're slowly growing what you can do because you make some money and you take your profits and you reinvest it into whatever it is you're doing. This is exactly what I do on YouTube. Anytime somebody watches our videos on YouTube, I get paid. Thank you for your penny. Now, when I get this YouTube money, I can take all of it and go out and buy myself some new exotic cars, go get myself a new Gucci wardrobe, and go enjoy some fine dining at Chipotle with some extra guac. But what I actually do with this money is I reinvest this money back into our business. That way we can grow our business bigger. I'm reinvesting it back into our blog, I'm reinvesting it back into our newsletter, and I'm reinvesting it into an app that we're making. I'm actively working to compound this money by sacrificing some of these luxuries today that I could buy by reinvesting this money back into the business. That way I can grow the whole pie bigger. When I was in college, I started a cell phone accessory business with a friend of mine, and we didn't have a ton of money, and we wanted to start selling these like cell phone battery packs, and at the time we only bought like 10 of them because that's all we could afford. And so we bought 10 of these battery packs and we sold them, and then we took this money that we got and our profits and we went out and I think we bought 20 battery packs, and then we bought 50, and then we bought 100. And so it was like a slow compound where we took whatever money we had to buy these battery packs, we sold them, then we took this money and our profits and we compounded it. And that way we were able to buy more, sell more, buy more, sell more. And so you don't get to enjoy the profits when you're compounding it like this, because if you're taking all of your profits and reinvesting it, you're actively compounding it to grow the whole thing bigger. When you do this, the hope and the whole idea is you're gonna start off with something small, $100 or $1,000, and you're gonna grow it to something a little bit bigger. You're gonna turn $1,000 into $2,000. Now you're gonna reinvest the $2,000, turn it into $4,000, then the 4 to 8, the 8 to 16, and you're gonna slowly keep growing it. There is a risk though, because if you keep growing it and you don't take out any money for yourself, eventually there's a chance that things don't work out. And now you grew your $1,000 into $100,000 or $1 million, and then things fail. And if you didn't take out any money for yourself, now you're left with nothing. So if you're doing this type of active compounding, you really just gotta find the right risk balance for you, because anytime you pull a dollar out, that's a dollar that you cannot compound. But if you keep the dollars in there, then you take on more risk. I mean, this is one of the things that made Elon Musk so financially successful, because in the early stages of his career, when he would make $25 million, he would reinvest all of this money back into his business, and he would leave nothing for himself, because he wanted to compound and grow his dreams and his wealth by taking every dollar he had and throwing it back into his beliefs. The second way you can compound your money is the passive way, and this is what a lot of people think about when they think of compound investing, because now what you're doing is you were taking your money and you're putting it into an investment, and you're gonna let your money grow, and anytime your money makes money, you are gonna reinvest that money back into it. That way this money that you have growing is gonna keep growing, even if you don't add money into the pot, because your money is growing and this new money is gonna be working to make you money too. When I was in high school, anytime we talked about compounding or investing your money in my math class, the example that my teacher always gave me was investing your money in a CD in the bank or a savings account. So the way it works is you put your money in the bank, either in a CD or a bank account, and then your money is going to grow, and as your money sits there, it will compound and grow, because now this money that your money made will grow even more. But the interesting thing about this, so if we write bank account, you're not going to get a very good return, especially nowadays. A savings account nowadays is going to pay you like 0.1% if you're lucky, and a CD is going to pay you 1% if you're lucky. So if we look at this where you get a 1% return on your money, and I'm being very generous here, it is going to take you a long time for you to double your money. At this rate, keeping your money in the bank is going to take you 72 years to double your money. So you're not building wealth in this lifetime. Maybe your great grandkids will have some decent money to play with. If you're really looking to compound your money and grow your money, then you need to be putting your money in assets. So this would be things like the stock market. If you're investing in your money in the stock market, the goal is to grow your money by investing in companies that you believe in, because over time these companies are going to make more money, which will make the stock price more valuable for you. Now, if I come back here to active, if you do a business or flipping like we talked about, there's really no limit or kind of a baseline to how fast you can grow your money here. I mean, it's not super unreasonable to see 100% growth in a year, so it's really kind of uncertain as to how good of returns you'll see. It just depends on what it is you're doing and how good you are at it. So, there's really no baseline here. The stock market, on the other hand, has gone up by between 8 to 10% a year historically. So even if we stay on the low end here, 8%, you're going to be able to grow your money much faster. And the thing you got to understand about the stock market is there's a couple of different ways that you can make money. You can make money through appreciation, which is when the price of your stock goes up, and you can also make money through dividends, which is when the company that you invest in literally just gives you a cash check. So if you can grow your money by 8% a year in the stock market, you can double your money every 9 years. That's a whole lot better than 72. Now, if we kind of really look at compounding your money, this is where a lot of people assume that you have to invest in dividend-paying companies, which are companies that pay you cash payments. That way you can compound your money, because in that case, when you get this dividend, then you could reinvest this dividend back into the stock market and buy more shares. That way now your money is actually growing. So you invest in a dividend-paying company, this company gives you some cash, then your money automatically gets invested. That way you can own more shares, and now as you own more shares, you're going to get more dividends. As you get more dividends, you can buy more shares, so it creates this reoccurring cycle of growth and compounding. This dividend reinvestment strategy is a great way for you to build your own wealth, because now anytime you get paid, you're going to automatically reinvest this money. If you want to learn more about how to do that, our team broke this down in an amazing article on our website where it shows you, one, how to do this reinvestment, how to invest in companies, and how to find a good brokerage that does this. So if you want to learn more about how to do that, I'll link the article for you in the description below. But what I also want you to understand is that not every company pays a dividend. The only companies that really pay dividends are really your more established and more mature companies, because these are companies that at the end of the year, they have so much cash in their bank account, they have no better use for their money. Because if they could reinvest this money back into their company and grow their company bigger, then they would probably do that. But they have so much cash where they're just like, you know what, let's just start giving it away to our shareholders because we have no better use for this cash. And so people assume that the only way to compound their money is to invest in dividend-paying companies, because these are companies that are giving you cash, and when you get this cash, you can reinvest it. But you can also compound your money by investing in companies on the stock market that are reinvesting their profits. If you find more of a startup company that you really like and you really believe in and you think is a good value, and you invest in this company, and this company, anytime they make money, they don't give it away in dividends, they take this extra cash and they reinvest it back into their company, so they're really not making that big of profits. Like how Amazon during the early years of it being public never made any money, because anytime it made money, it reinvested it back into the company. If you invest in a company like this, then your money is still compounding, because you own shares of a company that's using all of its money to grow itself. And so while you're not getting this cash payment and accumulating more shares, your shares become more valuable because of this compounding, because the company that you're investing in is compounding all their money because they're taking all of their profits and reinvesting it. And there are pros and cons to both, because this type of investing, where you invest in more of a startup type company, has more risk, because there's a chance that this company will fail, like we talked about here. If you're actively compounding your money, which is what this company is doing, there's a chance that it could fail. And so yeah, they're reinvesting all their profits and they're doing everything they can. But if this strategy fails, then there goes your investment. But on the flip side, with these dividend investments, because these dividend paying companies are typically larger and more mature, you're going to have a safer investment, which usually comes with a smaller return. So you might not see the stock price go up as fast, and your average dividend is typically somewhere in the 2 to 4% range. It really depends on the company, so it's not anything huge, and hopefully it will go up over time, but you just got to kind of understand where you want to be. It comes with lower returns here, higher potential returns here, but more risk. The second thing is with dividends, anytime you get paid a dividend, you have to pay taxes on this dividend. So while you take this dividend and you reinvest it, you still have to pay taxes on the money that you made, even though you don't actually get that money in your bank account, because you're, in this case, reinvesting that money. Another way that you can compound your money is by investing your money in real estate. This is my actually favorite place to invest my money, because not only do you get passive income, if you do it right, you will also get the appreciation in the property. And so with real estate, when I invest my money, I'm looking for a 7% annual return on my money, cash on cash minimum. Ideally something closer to 8%, but 7% is my real minimum. Now the thing that you got to understand here is that if I get a 7% return on my money, it's going to take me 10 years to double my money. But in this case, the 7% is a cash on cash return that I'm getting every single year in my pocket. So if I buy a $100,000 property, that means every year I'm making at least $7,000 in profit. Hopefully over time this is going to go up if rent prices go up, but that means I'm making $7,000 a year. And now what I can do is, after 10 years, I will have this cash in the bank that I can use to go out and buy another property, or I can just take my own cash, go out and buy another property, and supplement it with this money that I'm making from real estate. The reason that real estate becomes so attractive now on top of this is because not only are you getting this cash flow, but if you're buying your properties in a good area where people want to live, then you're also going to see the property value go up too. So I buy this $100,000 property, and every year I'm getting $7,000 a year in passive income, but over time, this property might go up in value to, let's say, $200,000. And now if it comes time for me to sell this property, I sell it for $200,000, I can do something called a 1031 exchange. It's a little loophole in the real estate world where now I can take all $200,000, pay $0 in taxes, and go out and buy a $200,000 property that's going to pay me with more passive income. And so when I try to do that in the stock market with dividends, the first thing I had to do was pay taxes on my dividends, and then I could reinvest these dividends. With real estate, if the property value goes up, now I can sell the property, pay no taxes today on those profits, and go out and buy myself a bigger property that's going to pay me with more money. Plus, even on the passive income, the cash flow that I'm making from real estate, this money that I'm getting here, there's a lot of tax breaks that I get with real estate that I don't get with the stock market. So even as I get the $7,000 a year in passive income, I don't have to pay taxes on all $7,000 because there's other tax deductions that I can take, like something called the depreciation tax deduction, which says that I get to get a deduction because my property is 1 year older. So happy birthday to your property, you get a tax break. So from a tax perspective, you get more benefits here from real estate, but real estate does come with its own downfalls because now you have to deal with more people. Like when you're investing in stocks, you're not dealing with anybody. You can go out and buy shares of Amazon or Lululemon or Chipotle and McDonald's and not have to deal with a single person. You can do this right off your phone. You want to go out and buy a real estate property, you got to have a real estate agent, you got to have a property manager, you got to deal with a contractor, you got to deal with an attorney, and you got to deal with tenants. And so if you don't want to be in that game, the stock market is better for you. Plus with real estate, you're in charge. You're the one that actually has to make sure that your property is generating income, and it's more work on your end because now you got to be the one that's negotiating the deal. And if your tenant doesn't pay or if your tenant damages the property, that's a cost that you have to pay. And of course, the most obvious thing is that it takes a lot more cash to start investing in real estate than it does to start investing in the stock market. I mean, you can start investing in stocks with as little as $100, but if you want to go out and buy a property, you can't do that for $100, at least not a good property. Now, while it's your decision on where you want to invest your money here, here, or here, the idea stays the same, that you need to compound your money. The whole idea behind that is anytime you make money, you want to reinvest at least some of it. That way your money is growing and the money your money made is growing. That way you can grow your money quicker and quicker and quicker over time, because the real secret to building wealth is investing. Yes, we talk about that all the time, but if you really want to grow your money quicker, you got to compound your money, which means you got to have more money in the fire that's burning to make you more money. But I guess if you're burning money, that's probably not what you want to be doing. So bad example, but you got to have more money working to make you more money. We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, M1. If you've been watching my videos, you've probably heard of me talk about passively investing your money in the stock market, where you have a CPA, a consistent, passive, and automatic system where money is automatically invested into the stock market for you. Well, a super easy to use platform that can help you passively invest your money into the stock market is M1. And as a little disclaimer, at the time of me recording this video, M1 is a tool that I use to passively invest my money into my portfolio of ETFs. The way it works is you get to create your pie or your portfolio of ETFs or stocks that you want to invest in, and then you can create a cadence of how often you want to invest into this portfolio of ETFs or stocks. For me, I invest every Wednesday. You can invest every 2 weeks, every month, but once you pick the cadence, you set it and forget it, and M1 is completely free for you to use. Now, of course, investing has risks. Are you guaranteed to make money when you invest? No, of course not. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But you can mitigate some of your risk by investing your money into good assets for the long term, which is why I invest my money into my portfolio of ETFs, whether the market's up and down, because I'm investing for the long term. Now, of course, you want to do your own research, get a financial advisor if you need one, but M1 is a great tool that can allow you to passively invest your money yourself. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and create a free account with M1, I got the link to how you can do that down in the description below, or you can go to theminoritymindset.com/M1. That's theminoritymindset.com/the letter M and the number 1. And with that, let's go back to the show. If you had to turn this $100 bill into $200 as fast as possible, what would you do? This is one lesson that everybody should learn before they graduate high school, and by the end of this video, you're gonna know exactly how to do that. The answer that the majority of people would give is take that $100 to the roulette table and put it all on red, except it doesn't matter which seat you sit on or what time you go, you're probably going to lose that money. Rich people have figured this out though. They figured out the game of how they can double their money as quick as possible, which is how they're able to compound their wealth, and it's all because they understand this one concept of compounding your money with growing contributions. If you can understand that idea of compounding your money with growing contributions, you will know how to double your money, triple your money, quadruple your money. If you put your $100 into your savings account in the bank, you might be able to get a 1% return on your money if you're lucky, and it's going to take you 72 years to double your money. If now you take your money and you passively invest it into the stock market, you can expect to get a 7% return on your money over the long term. That doesn't mean you're going to get 7% every year. Some years are going to be more, some years are going to be less. But over the last 100 years, we've seen that you should be able to get a 7% annual return on your money, which means it will take you 10 years to double your money. Now, if you want to be a little bit more actively involved with your investments, where you don't just passively put it in the stock market, but you're looking for good companies, you're looking for good real estate investments, you're actively finding better investments, well, now you might be able to get a 10% return on your money. If you can get a 10% annual return on your money, it's going to take you 7 years to double your money. But if you can get an even better return, if you can get a 20% return on your money, well, now you can double your money every 3.8 years. And if you're wondering, but Jaspreet, where in the world am I going to get a 20% return on my money? Well, your credit card company is doing it each and every year. So if you carry credit card debt and you're paying interest on this credit card debt, you are making your credit card company rich at the expense of your future wealth. Then, if you can get a 50% return on your money, well, now you can double your money every 1.7 years. Again, you might be saying, but Jaspreet, where in the world am I going to get a 50% return on my money? Well, now if you can go out and start a business, you might be able to grow your business by 50% year over year, especially in the early stages of your business. You see a lot of startups grow by 20 to 50%, especially in the early 5, 6, 7 years of their business, because now you're able to grow, you're able to acquire more market share, and you're able to get bigger profits. But if you're able to get a 500% return on your money, well, now you can see your money double every 5 months. Again, you might be saying, Jaspreet, where in the world am I going to get a 500% return on my money? Go to the roulette table, you go to the casino, you can get a 500% return on your money, you can double your money every 5 months. However, you're probably going to lose your money. So the chances of you getting this are very low. This is where the next thing you have to understand is risk versus reward. Higher up here, you have much less risk. Down here, much higher risk. Down here, much higher reward. Up here, much lower reward. I don't recommend anybody take their hard-earned money and try to double it in the casino as a financial planning method. That is not what I'm advocating for. But what I'm saying is you have to understand higher risk comes with the potential for higher reward. Starting a business can make you extremely wealthy. It can make you a ton of money. It can make you more money than you ever imagined. But it's a ton of work. It's a ton of risk. The majority of businesses will fail. Then out of the small businesses that succeed, most of them will never make $1 million in a year. And out of those companies that make $1 million in a year, most of those will never make $1 million worth of profit a year. It is very difficult to scale a business and make it successful. However, that return potential is there. You don't have this type of return potential when you put your money in the savings account. When you put your money in your savings account, you know your $100 is going to be $100 tomorrow. It's going to be $100 in a year. It's going to be $100 in 2 years. Maybe a few extra pennies added to it. It's safe, but you're not going to get any returns. And this is where now you have to understand that risk and reward, but you also have to understand what I said just a minute ago, the compound interest with growing contributions. This is where things get really fun, and this is what rich people love doing. So I gave this example before, but let's assume that you can invest $4 a day. You start doing this from the day you turn 21, and you do this for 45 years, and you can get an average 10% return on your money, which historically has been the S&P 500 index average over the long term. This doesn't mean you get a 10% return every year, but if you put your money into the S&P 500 index 100 years ago, you would have averaged a 10% historical return. But if you do this, your $4 a day over the course of 45 years would have been just under $66,000 that you invested. But because you're able to get this 10% annual return, your money would have grown to $1.1 million. But what if now you don't just invest $4 a day, but you do growing contributions, meaning every year you contribute a little bit more than $4 a day. Every year you contribute, let's just say, an additional 5%. That means this year you're investing $4 a day. Next year, you start investing $4.20 a day. The year after that, you start investing $4.41 a day, and on and on and on, because every year you're working to get a raise, you're working to earn more income, and as you earn more income, you also invest a little bit more aggressively. Well, if you do that, and you keep the same years, you do this for 45 years, you get the same 10% annual return, well, now you're not going to have $1.1 million. You're going to have over $2.1 million. You just added an additional $1 million to your bottom line, to your investment portfolio, to your cash, because you started investing a little bit more aggressively. Because what happens? Inflation happens. 45 years from now, $1 million is not going to have the same buying power as it does today. But you're also not going to be earning the same amount of money. So if you can grow your investments, well, now you're going to be able to grow how much money you can have when it gets closer to your retirement age. And if you're wondering, but Jaspreet, what if I don't want to wait until I'm 70 years old to start enjoying my money? Well, I'll talk about that in just a little bit. But this is where understanding that if you can grow how much money you're investing, you can significantly increase how much money you will have. We're talking about $4 a day here. But if you can increase how much money you're investing each and every year with the income that you're making, so every time you earn more money, you invest a little bit more aggressively, well, now you're going to be able to grow your wealth. But it gets even more fun, because what happens now if you invest more money because you're earning more money, but you also invest more money because your investments are making you more money? This is where the power of compound interest really starts to come in. Albert Einstein called compound interest the eighth wonder of the world, and the reason why it's so powerful is because the people that understand it can become incredibly wealthy. But the people who don't understand it, well, you're going to be subservient to the people who understand it. Because now what you can do, not only can you grow your money, but let's assume that now your money is spitting off some cash flow because you're investing in dividend paying stocks, you're paying in rent producing real estate. Well, now you have some cash flow coming in. You got these returns, which is great, but you have cash flow, and instead of spending this money, you also throw this into here. So now instead of having a 5% annual contribution, maybe you have a 9% annual contribution, because you're working to not only increase how much money you're investing, but your investments are also throwing more money back into here. Now take a look at this. You're still investing your $4 a day right now, but every year you're working to increase your annual contribution by 5%. You do this for 45 years, you get a 10% return on your money, but assuming that you can get 4% cash flow, and you take that 4% cash flow and you put it in here, now your annual contribution is going to be growing by 9%. Now you're not going to have $1.1 million. You're not going to have $2.1 million, but you're going to have more than $4 million in your investment fund, because now you had the power of compound interest with growing contributions. This is what wealthy people are learning to master. Now the question is, what do you do to get this 10% return right here? What do you do to get this return on your money? Because time is one of the most valuable aspects, right? There's three aspects to this. There's how much money you're investing, how much time you invest for, and what type of returns that you can get. Well, this is going to depend on your income. If you have an income problem, you should be working to increase your income. Invest this money in your own education. Go and watch YouTube videos, go read books, go take classes, go get coaching, go get consulting, go do something to invest in yourself to learn how to increase your income. If you don't have the money to invest, you have to start with that. Figure out what can you do. Cut expenses, make more money so you have more money to invest. Once you do that, now, you can't change too much about where you are in your life right now. If you're 21, great. If you're 18, great. If you're 45, great. You start where you are now. If you haven't started yet, you need to start now, so you just get started. Sure, if you're older, it's going to be a little bit tougher. Doesn't mean it's impossible, but then you can make it up here. If you're older, it's going to be more important for you to earn more money, to have more money to invest, right? It's all a formula. These are the three different areas where you could improve. If you can't improve here, you got to work to improve here, where you can work to improve here. So if you can't improve in one place, you got to find the other place to improve. Then this is where you can also improve how you can get better returns. And this doesn't mean that you have to go out and just throw your money at the casino, but how can you strategically get better returns on your money? I'm not going to talk about this in this video, but I want to talk about this. Let's jump back to risk versus reward. Now, before I go deeper, if you do want to learn how to be a better investor and you want to stay up to date on what's happening in the financial markets, if you haven't already, I would highly recommend you join Market Briefs. Market Briefs is my free newsletter that I created, which keeps you up to date on what's happening in the financial markets, from the stock market to the real estate market to crypto to the global economy to our own economy. That way you can understand what's happening in the markets so you can make smarter decisions with your money. Market Briefs is completely free and you can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. We talked about risk and reward, but there's one more aspect that I didn't talk about, which is time in the economic cycle. Now, this doesn't mean that you need to time the market, but understanding that different phases in the economic cycle are going to give you different returns. And I'll explain what that means. When I first started investing in real estate, this was after the 2008 crash. And I was very fortunate that I started investing then because I didn't know anything about investing. I just started investing in real estate because the books that I read said that wealthy people invest in real estate. I didn't know any real estate investors, but I decided to do it. And when I started investing in real estate then, for me, I thought a decent return wasn't a 7% cash flow. It wasn't a 10% cash flow. It was 20%. This is going to sound very crazy, especially in our economic cycle right now. But back then, you were able to find good homes in good areas for $50,000. And then you would be able to rent them out and make $10,000 a year of profit. That's a 20% cash on cash return on your money. And now those $50,000 homes are selling for $150,000 to $300,000. Here's another example. Again, I'm not telling you what to invest in. I'm just giving you examples. You always want to do your own due diligence and never blindly trust a random guy on YouTube. So when you had the 2020 pandemic hit, you saw the entire stock market get cut in half. Well, you have some high dividend paying ETFs. These ETFs focus in on just high dividend yields. A few examples of this are SDY, SCHD, and VYM. For a disclaimer, I do have some of my own money invested in SCHD and VYM. Well, when the stock market got cut in half, the prices of these high dividend yielding companies and ETFs were also cut in almost half. So you saw these high dividend yielding ETFs, which normally yield somewhere between 2.5% to 3%, now saw their prices cut in almost half, which in effect meant that you could buy the same cash flow for almost 50% off. And so you were almost able to come in and buy the same dividend yield and now get a 5 to almost 6% return on your money, a 5 to 6% yield, just because you can buy these ETFs for almost half off. Now, I like cash flow because cash flow is king, but this is where you need to balance the three aspects. You have risk, you have reward, and then you have the timing. There's always going to be opportunities, but in order for you to find these opportunities, you have to be financially educated and you have to be willing to take on risks, because anytime you see these big opportunities, everybody is running away. When the 2020 pandemic hit, people were running away from the stock market, people were selling out of the 401ks, people were scared, but it created big opportunities for people who started buying good assets. When the 2008 crash happened, people were running away from real estate, but it created good opportunities for people who were buying real estate then. When the 2000 dot-com bubble burst, people were running away from internet companies, people were selling off all of the digital tech companies, but it created huge opportunities for people who came in and bought then. So it creates opportunity if you have that financial education and you're willing to take that risk, but most people don't have it in them to do that. So then you focus in on the risk versus reward and you ignore what's happening in the economy. So you ignore what the timing is, you ignore what's happening in the economy, and when I say timing, I don't mean timing the market, but I mean looking for the opportunities, the big opportunities when they come your way. If you're not willing to do that, no big deal. Now you understand the risk versus reward. Here, you have no risk and also no reward. Here, high risk, high reward. Starting a business is very risky, but it can be extremely rewarding. The way that you can move down this list and get better returns without taking on a whole bunch of risk is through your education. Education is how you lower your risk. And how do you become educated? Well, you can read books, watch YouTube videos, take classes, get courses, get education, get coaching, get whatever, but you also got to make the mistakes. No education through somebody else teaching you can bypass the mistakes that you have to make, because you got to be willing to learn. In order to go from here to here, you're going to have to make some mistakes. Those mistakes are going to cost you money. Those mistakes are going to be painful. Those mistakes are going to make you want to rip your hair out. But that's what's going to allow you to go from this return to this return to this return. And you have to be willing to go through these mistakes if you want to get better. So how do you get better? You get started. How do you get started? By just doing it. Now you do it, you make mistakes, and then you get better. You learn, you screw up, and you make better mistakes, because now as you make mistakes, as you lose your money, you're not going to want to do it again. You're going to want to see what it was that made you lose money in the first place. And this is where a little bit of an investing 101. Don't invest more than you're willing to lose. If you're not willing to lose that money, your money that you invest has to be separate than your savings. It has to be separate than your spending money, and it's its own money. The money that you invest is a separate portion of money that's investment in you, investment in your assets, investment in your future wealth. You're gonna see dips. You're gonna see times where you lose this money, but that's how you learn, that's how you get better, and that's what's gonna allow you to get the better returns. Most people are never willing to go through that process because they never wanna look stupid. They never wanna make those mistakes. But if you're willing to look stupid, then it doesn't matter if you make a mistake, because now you can laugh at it and then you can learn how to be better. And I know it's very hard to laugh when you're losing that money, because I've been there. I have made very bad investment decisions when it comes to things in my own business. I've made very bad investment decisions when it comes to my real estate investments. I've made very bad investment decisions when it came to investing in startups. I have made very bad investment decisions when it comes to investing in the stock market. But I've also made some very good decisions. And those very good decisions have very much outweighed the bad decisions that I made. And those bad decisions were what set me up for the good decisions. So you have to be willing to make the bad decisions. That way you can make more good decisions in the future.
We're going to jump back into the show in just a minute. But first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show.
If your goal is to make $100,000, the first thing that you have to do is quantify what it's going to take for you to actually make that $100,000. Now, in order to make money, you have to be able to sell something. That's the way the world works. You sell something in exchange for money. And if you are selling something that costs $10 and your goal is to make $100,000, that means you're going to have to sell 10,000 of these items to make the 100 grand. And if you want to achieve that $100,000 over the course of a year, that means you're going to have to sell 27 of these $10 products a day in order to do that. If you sell something that makes you $100, well, now you're going to have to sell not 10,000, but 1,000 of these items. And if you want to hit the 100 grand in 1 year, that means you're going to have to sell about 3 products a day. You're going to have to sell one every 3 days. And if you can sell something that makes you $10,000, well, now you only need to sell 10 of these, which means you only got to sell about 1 a month in order to hit that 100,000 goal in 1 year. This math is the easy part. Anybody can do this. The next thing is, what are you going to actually sell in order to make this $100,000? You have 4 different levels of opportunities that can help you get to $100,000 or a whole lot more. Number 1 will be the low risk and low reward opportunity. Number 2 is the high risk but low reward opportunity. Number 3, which is probably the most popular, is the high risk but also high reward opportunity. And then number 4, which is my personal favorite, is the low risk but high reward opportunity. I like this one because I have the least risk but also the most upside. Now, a low risk, low reward opportunity would be something like just taking your cash and putting it into a savings account. Because now when you put your money into a savings account, you have very little upside, so very little reward, but also very little risk because you're FDIC insured. And if you put $1,000 or 10 grand into the bank today, well, when you check your bank account in a month or a year, it's going to stay the same. You're not going to get any growth, but that 10 grand is going to be there. You don't have to really be worried about losing that money by saving your money in the bank. A high risk but low reward opportunity would be something where you have nothing proprietary. This is something like selling on Amazon as an Amazon FBA reseller. If you were any good, well, you would be completely undercut by other people. Because if you can sell on Amazon, it's going to cost you a lot of money to start. You might have to go out and go into debt to start selling on Amazon. And then you're only selling somebody else's stuff. You have nothing proprietary, so everybody else can compete against you. And if you are any good and you can take any sort of market share, well, then Amazon is going to notice. And then they're going to create the exact same product that you're selling, and they're going to undercut you. And so now you've worked so hard to build this market share, and now you're going to be competing against Amazon. I don't like the idea of having something that can be competed against by anybody else or working on somebody else's platform to sell something where they can just come and undercut me. So it's high risk in that sense that if I'm any good, someone else is going to come and just take my spot, but also low reward because my upside is capped. If I start taking any market share, well then Amazon is going to come and sell the same product as me, and I don't have anything that I can sell because I don't have anything proprietary. An Amazon FBA business isn't a very sellable company. Yeah, you have some Amazon FBA businesses that are being sold, but relative to owning your own product, owning something that you can control, owning something that you created, you're going to have way more upside with that than just selling on somebody else's platform. Then you have the high risk and high reward opportunities, and this is where a lot of people get drawn to, because these are the things that draw in a lot of hype and a lot of excitement over the hopes of being able to get rich very quickly. This would be something like throwing your money into a meme stock. If you put your money into a meme stock, you might be able to 10x your money in 12 months. But there's also a chance that you're going to lose everything. So a lot of people jumped onto that idea, hoping that they'll be able to be one of the winners who can 10x their money. You saw similar things in the crypto space. When the crypto boom was happening in 2021, you saw this huge boom in crypto staking, some of them being super risky cryptocurrencies that really had no underlying value. The whole hope was that these cryptocurrencies would pay you like 700% interest, and then you would be able to sell this crypto to somebody else who didn't really care about the value of crypto. So you were just selling something that was worthless, hoping that you could get a lot of interest on something that was worthless. And the real hope here was that you'd be able to sell out before people realized how worthless this crypto was. And some people made a lot of money, but most people lost everything. So you have that high risk, high potential reward. This is also people who trade options, especially with a lot of debt. You have the opportunity to make a lot of money, but it's also very risky. I don't put my money into these types of opportunities because it's too risky for me. It's the same reason why I don't trade stocks. It's the same reason why I don't flip real estate. I don't like the high risk, high reward mindset. Instead, I like the low risk, high reward mindset, where now I can have much lower risk, but I can keep the upside if I have higher rewards. Now, personally, I wouldn't put passive real estate investing and stock market investing into this quadrant. I'd kind of put it somewhere here in the middle because it's a passive investment where now I'm just looking to get a 7 to 10% return on my money. So it's not a super low return. It's also not a really high return. It's just something more of a passive way to invest. So it's somewhere in the middle. But when I talk about the real low risk, high reward opportunities, this is where now I'm more referring to things like my own businesses, things like Briefs Media. Briefs Media is a financial newsletter company that I created. And for me, this was a low risk, high reward opportunity because for one, I have an audience here on YouTube who is interested in finance and entrepreneurship and money management. And it's a way for me to now create something to benefit my readers. My Briefs Media company creates newsletters. I have a Market Briefs, which is a newsletter for investors. And then I have Business Briefs, which is a newsletter for business owners and entrepreneurs and founders who want to be better with their business. Both of these newsletters are completely free. And it didn't cost me a whole lot of money to start it because I already had a staff working for me at the Minority Mindset Company. And so then we started creating this newsletter. Well, this newsletter, now I could market it directly to my audience. So my cost to start the company wasn't that high. I don't have to go out and spend hundreds of thousands of dollars hiring new people because I already had a staff that had the ability to write these newsletters. And then as the newsletter started to grow, now we were able to monetize. You might be wondering, how do you monetize if it's free? Well, we have some advertisement spots that we sell to our sponsors. And so now I'm able to market it for free. We were able to get it started at no additional cost. And so now we have a lot of upside because the newsletter can keep growing. The more the newsletter grows, the more advertisements that we can sell and the more that we can sell these advertisements for. So low risk because it's low cost to start. It didn't take me a whole lot of extra energy to start. And high reward because the business is scalable. There's no limit to how many people can read the newsletter. And so if we can keep growing the newsletter, we'll be able to charge more money and grow our revenue. It's very scalable. Compare that to something like here, where if I owned a physical store, now there's a lot of risk involved because it costs me money to open up a store. I have a physical presence I have to pay rent for. I have to hire an employee to work there. But there's also a limit to how much money I'll be able to make from my physical store, because there's always a limit to how many people can come inside. There's a limit to how many sales that I can have in an hour. And there's a limit to how many hours the store can be open. Versus with something digital, I have none of that. There's an unlimited upside when you go digital, because now when you go digital, your costs slightly go up when you have more users or customers or whatever on your site. but your revenue can scale disproportionately faster. Another example of a low-risk, high-reward opportunity will be to create some sort of education or service-based company digitally. So if you're good at fitness, you're good at finance, you're good at music, what you can do is you can create a class on how to do what you do. If you know how to manage a company's accounting really well, if you know how to play guitar, if you know how to lose weight, well, now you can build a class on how to do this and you can market it online. And now there's no limit to how many people can take this class, and you can charge anywhere from $100 to $2,000 or $3,000 for this class, depending on how intensive it is. Or if you want to be a little bit more involved, well, now you can create some sort of consulting or coaching, depending on what your skill is. If you're an accountant, well, now you can offer your accounting services. If you are a fitness coach, you can offer your fitness services. And now this can supplement your class, because now you don't have to recreate this class every 6 weeks. You create the class once and people can buy it again and again and again. And then you can supplement that with your coaching services, your consulting services. And now you can charge a whole lot more for this, which allows you to do something that's low risk because you already have the education. It's not going to cost you a whole lot of money to build this, but again, high reward, because now you can start scaling this a whole lot more. Another example of this, moving away from the entrepreneurship space, would be investing into your own degrees or investing into your own education through something like a certificate. Because if you can pay $5,000 to get a certificate in data science or to get a certificate in some sort of thing that can double your income, well, that's pretty low risk and high reward. Because if you know what the cost is going to be, you got to pay $5,000 to get a certification to learn how to do X. And this X is going to allow you to get X plus Y return on your money. That's a pretty low risk, high reward opportunity. Not everybody is meant to be an entrepreneur. Not everybody has to be an entrepreneur, but investing into your own degree, investing into your own income will allow you to earn a much bigger income. And that's where now it's much low risk with a higher reward if you know that investing into the certificate can increase your income by a certain percentage. Now, if you want to create a product, sell it, and scale it, there are 3 things that you're going to have to master, or 3 things that you're going to have to do. And these 3 things are what every single business in the world has to understand if you want to be able to create a product, sell it, and scale it. First, you have to understand growth, then operations, and finances. Now, the thing that you have to understand is, for the purposes of this video, we're talking about going from $0 to $100,000. And the things that you're going to have to do to go from 0 to 100 grand are very different than the things that you're going to have to do to go from 100 grand to $1 million. And the things that you have to do from $1 million and above are going to be very different than that. The things that I'm focusing on today are how do you go from 0 to $100,000. And if you're going from 0 to $100,000, the place that you're going to want to focus is here on the growth side. Operations are not going to be that important. Your cash flow management isn't going to be as important. You're going to worry about that after 100 grand, sometimes even after $1 million, most of them after $1 million. But from 0 to $100,000, what you need to do is you got to figure out what your product is and you got to sell it. Going from 0 to $1 is going to be just as hard as going from $1 to $100,000, because right now it's the basics of learning. Where do you start? What do you do? How do you sell it? Now, what do you do after you sell it? Right now, it's all about growth and getting started and creating a product and just start selling it. A lot of people get confused here because they try to jump steps. You start optimizing, you start working on A/B testing, you start working on all these little details before you've even made your first $100,000. If you haven't made $100,000, you don't have to worry about split testing. You don't got to worry about A/B testing. You don't got to worry about optimizing. You don't got to worry about creating systems. You don't got to worry about doing any of that. The only thing that you have to do right now is create a product and sell it. You don't have to worry about spending all that time, effort, and energy doing all that other operational stuff. Right now, what you need to be doing is figuring out how do you make that first $100,000. And if you haven't made that first $100,000, stop investing that time, effort, and energy doing all that other stuff and just start selling your product, doing whatever it takes. So now if I take a step back, before I go into actually how do you grow and how do you start selling to make the $100,000, the first thing you got to know is what are you selling and what are you doing? And in those early stages, you're going to probably be very confused. Do I do something in fitness? Do I do something in finance? Do I do something in healthcare? Do I do something in, I don't know, whatever your interests are, because you're going to be jumping around in interests. You're going to be just trying to figure out how do you get started, especially if you haven't sold $1 yet. You're going to be jumping around trying to figure out where in the world do you want to be. And now you're going to see all these opportunities on the internet. You're going to see YouTube videos, you're going to see people selling books, you're going to see people having classes, you're going to see masterminds, you're going to see coaching groups, you're going to see consulting sessions. There's going to be so many opportunities out there, and this is where you want to start to get narrowed. Before you go out and start spending money on these things, I want you to start by doing two things. Start by watching as many YouTube videos as possible in the different places that you are interested in. And these could be very different things. So start by watching as many YouTube videos as possible. Start binging videos so you can start learning without paying any money. And also start reading books. Start reading as many business books as possible. Read business books about marketing. Read business books about scaling. Read books about how to sell a company. Read books about how do you actually grow a company. Read books about how do you manage people. Read books about leadership. Start reading as many business books as possible while absorbing content. Then as you're watching YouTube videos, the next thing is you're probably going to start diving into a couple different areas. You're going to find a couple different things that you're interested in, and that's when now you're going to want to start investing in yourself. This might be now investing in classes, investing in coaching, and investing in masterminds. And you're going to see a lot of different opportunities out there. You're going to see people with different opinions that are selling different types of things. And you're going to say, should I go to this person or go to this person, or should I buy that thing or that thing? And this is where the best thing is to buy as many different pieces of education as possible. You're not going to go broke by investing in your own education, but you have to be smart with it as well. You don't want to go drowning into debt to buy this education if you don't have the work ethic to actually do something with it. You want to use the money that you have smartly and start investing in your own education smartly. That way you can learn and then actually apply what you learn, because the last thing that you want to happen is you just start absorbing information and you're paying money for information, but you don't actually do anything with it. And so if you're not going to do anything, don't spend any money. But if you're going to do something, if you know you have the work ethic, then start buying as many different programs as you can to get into the minds, to get into the circles of different groups doing different things. I have paid for educational programs in how to grow your Instagram page, to how to grow your YouTube page, to how do you do email marketing, to how do you grow on paid advertising, how do you do SEO. I've paid for programs on how do you do drop shipping and selling products through drop shipping. Some of these things only taught me one thing. Some of these things taught me a lot of things. But this is where you have to start now actually investing in yourself if you're willing to do something. Because if you're not willing to do anything, again, it's just going to be a waste of money. And so this is where you have to be honest with yourself and actually now start investing in yourself. That way you can start learning, but then also start doing. Now, as you start investing in this, you're going to start understanding what type of product that you want to create. Once you have some sort of product that you want to create, whether you're creating your own product, whether you're creating a software, whether you're creating a technology, whether you're creating a service, whether you're creating an educational product, whether you're creating some sort of media product, whatever now you're working to create, the next thing now is how do you get customers for your product? Because you can have the best product in the world, but if nobody knows about you, you're not going to make any money. And this is where you have to know how to grow. In the early stages, you're not going to want to spend any money on growth because you're not going to have any money. So now the question is, how can you grow without spending any money? There are two places where you can focus on growth that aren't going to cost you a whole lot of money, but it will cost you time. One is growth using media. This is things like social media, by creating content. And the second is by getting referral partners. 10 years ago, when somebody had a business idea, you only focused on creating the product. Nobody cared about the media side of the company because there was no media thing. You would just outsource it to a marketing company and then hope that they would bring you sales. Today, it's completely different. And 10 years from now, every company is going to have a media component in it where now you're working to create the product, but the second aspect is how do you actually market the product at an efficient way that way now you can also get the product out there into the eyes of people without spending a ton of money to do that. Because nowadays, media, social media, all these things are the backbone of how people absorb content, and it's the backbone of how people find products. People don't just want to buy a product, they want to support a person. And so nowadays, that media component, social media, whether it's Instagram, whether it's TikTok, whether it's YouTube, whether it's a podcast, people want to follow a person and then they will support that person's products. And this is where now you can start working to build this media presence. It takes more time, it takes a lot of effort, but it's a way for you to start at a low cost and start promoting you and your product. Now, if you're brand new to social media and you have no idea how to brand yourself, you have no idea how to grow your company on social media, where in the world would you start? Well, just follow the advice that we gave just a couple minutes ago. Start by watching as many YouTube videos as possible. That way you don't have to spend a penny trying to learn what it is that you're interested in. Watch YouTube videos on how to grow your YouTube channel. Watch YouTube videos about how to grow on TikTok. Watch YouTube videos about how to grow on Instagram. Watch YouTube videos about how to build a podcast. Start absorbing as much content as possible, then you start doing it. And as you do it, maybe now you start investing in a class, maybe you invest in a coaching program to help accelerate your growth. But this is where now you got to be strategic, where you don't just throw money into things. You start learning, you start doing, and then you start investing your own money and your own time even more. That way you can scale that, because social media will allow you to get the word out for your product at really very little cost. The second thing that you want to do is harness the power of referral marketing. And so one example that I can give you of this is through our own Briefs Media company. We provide a ton of value to our briefers, our readers. And one of the things that we do is, if you like our free newsletters, then we will reward you for sharing our newsletter with somebody else. If you're in market briefs, you can share the newsletter with another investor. And if you're in business briefs, you can share the newsletter with another business owner. And not only do we recommend that you refer our newsletter out, but we reward you for doing that. If you refer our newsletters out and you bring in other readers, we will give you free stuff. We might give you a free pair of briefs. See these bad boys right here? I have given away hundreds of these briefs away for free just as a reward, because people loved our newsletter and they gave it away and they recommended it to somebody else. Word of mouth marketing is the most powerful type of marketing, and you can rely on people doing that, but you can also incentivize people to do that as well. And on the flip side of that would be now to try to find influencers who will promote your product in exchange for money. Now, sometimes they're going to want money up front. Other influencers will take a percentage of sales that they bring in. So now what you're trying to do is you want to incentivize people who have an audience, who already have a following, to promote your product to their audience, and you only have to pay them if they bring you a sale. Now, you make $100 and you pay the person $20, you pay the person $30, whatever is a fair commission depending on what your product is. And that's where now you can drive more sales, drive more awareness, and you only have to pay when you get a sale. So you got to start by quantifying what it's going to take to hit your financial goals. Second, you got to understand your risk tolerance. Third, you have to understand the different ways that you can make the money. And fourth, once you know how you can make the money, this is where you're going to know how you can actually grow it to hit that $100,000 goal. That way now you can start making some money. And after you hit that $100,000 goal, that's when you can start thinking about the operational side. And after you hit that $1 million goal, well, that's when you're going to want to start thinking about the finance side. If you're over the age of 30 and you don't feel like you've saved enough money or invested enough money, the way you turn your finances around is not by cutting Starbucks out of your life. Instead, I want you to try this. See, most people assume that being broke is just a math problem that you have to solve. How do you spend less than what you make? Except there's more to it than that, and most of us are never taught this. I mean, if it was so easy, you wouldn't see the majority of people be broke with no savings, with little to no investments. If you really want to turn your finances around and become wealthy and become a millionaire, you have to understand two things. Number one is you have to understand the mindset and emotional side about money. And then you have to understand, number two, the practical side of money. Because if you just sit there, you close your eyes and you close your hands and you say, please God, please just put $1 million in my lap, you were going to sit there broke for the rest of your life. Which is why you have to understand the emotional side and the practical side of money. And if you stick with me until the end of this video, you're going to know exactly how to do that with a system of how do you start building wealth today. So let me jump right in with part one, because if you don't understand this, it doesn't matter how much financial education that you have, you will never become wealthy. By the way, if you stick with me until the end of this video, as a little bonus, I'm going to show you how you can get a copy of this ebook, How to Build Wealth as an Investor, that my team at Briefs Media wrote for free. All you got to do is stick with me until the end of the video. If you're anything like me, you didn't grow up with this healthy relationship with money. You grew up with this whole thinking that money is bad, it's taboo, it's evil, you shouldn't stress about money, rich people are bad. You grew up with this negative association with money, and the reason why you had this negative association with money is because your parents or your grandparents passed this on to you. And when you don't break the cycle, what do? You then take this knowledge, you learn it, you absorb it, and then you pass it down to your kids. And then you never actually understand how money plays a part in your life. But this is where I want you to take a step back and understand, how does money actually work? Because the reality is, money is just paper. It's not good, it's not bad, it doesn't have an emotion. Money is just there as a tool to allow you to buy things. And you're going to work every single day to generate this money. The more money you have, the more financial freedom that you can have. But this is where you need to understand how money plays a part in your life, because many times people put these smoke screens around money because they're insecure about their own money. And that's why it's important for you to understand how money plays an actual part in your life, because the reality is, it costs money to eat, and it costs money to feed other people, and it costs money to take your wife on the vacation she keeps asking for. It costs money to take your kids to that Disneyland vacation they keep asking for. It costs money to put your kids through college. It costs money to buy yourself that home that you want. It costs money to do all of these things, and this is where you have to understand, how does money actually play a part in your life? And what I put together is what I call my quadrifit theory, which goes over the 4 different fitnesses in life. That if you want to live a happy and fulfilled life, you have to be fit in these 4 areas. Because the goal isn't just to be rich and miserable. The goal is to have money and be happy. Because if you're rich and you have no happiness, what's the point of having all that money, right? So at the very base, you have to be physically fit. Because if you're morbidly obese, if you're on your deathbed, if you're very physically unhealthy, more money is going to make you feel more miserable. I mean, if you're on your deathbed, you don't care if you have $10 million in the bank. All you want is to be healthy again. So you have to be physically healthy first. Then it's this mental healthy. Mentally healthy means you have to be surrounded by people that you love. You have to be happy. If you're constantly surrounded by toxic people, if you feel depressed, if you feel anxious, more money is not going to solve this mental issue by itself. Now, maybe it can assist in some areas because financial issues are one of the leading causes of divorce and suicide. However, if you feel like you are unhappy in your environment, if you feel like there's this thing that's holding you back, you have to take care of this by itself. It means you got to get away from the toxic people. You got to put yourself in a good environment. You got to surround yourself with people that you love. You have to find your happiness. You have to figure out how you can go and do that. Maybe that means you go and get therapy. Maybe that means you go into a rehab place. Maybe that means you go and get some treatment. You got to do whatever you got to do to take care of your mental health because, well, if you try to solve your mental issues with more money, what you're going to end up realizing is that the more money is going to make you more miserable because now the money did not solve these mental issues that you're working to solve. Then you have to be spiritually fit. And spiritually fit does not mean you have to be religious. Spiritually fit means you have to have a purpose. What's the reason for you to get out of bed every morning? What's your reason for wanting to go and conquer things? Because, well, if you are spiritually unfit and then you go and get all this money, now you're going to feel even more miserable because now you have the money, but you have no reason to actually get out of bed and do anything with that money. So you have to figure out what it is that you're here on this earth for. Now, this is where a lot of people say, you got to find your purpose. This is the whole movement of what is your purpose? Well, let me tell you something. Your purpose is going to change every few years. My purpose today is not the same as my purpose when I was in my 20s. So don't worry if you don't know what your purpose is. Everybody keeps talking around Instagram and Facebook about you got to find your purpose. It doesn't work like that. You got to figure out what it is that gets you excited, that makes you want to do something. And the only way you figure that out is by going out and doing things. If you don't feel like you found your purpose, that's okay. Once you're spiritually fit, this is where now financial fitness becomes so important because it is the top of this quadrifit theory. Because now if you are financially fit, this allows you to live your life the way you want and live happy. Because the reality is you need money. You need money to pay your bills. You need money to do the things that you want. But now, once you have these, more money will allow you to live even more happy and more fulfilled because now you can do more things that allow you to be spiritually fit. More money will allow you to do more things that allow you to be mentally fit. More money will allow you to do more things that allow you to be more physically fit. You need money to be able to live your life. And this is where you have to understand now, how does money play a part in your life? And the interesting thing here is if you don't have money, well, the lack of money can really affect your spiritual fitness. Because now you can feel like you lost your sense of drive and purpose if you don't have any money. The lack of money can really affect your mental health, your mental fitness. Because if you don't have money, you're going to be fighting with your wife and your husband all day and all long about how you're going to pay your bills. You're going to be stressed out about how you're going to buy anything. It can really hurt you here. And the lack of money can affect your physical fitness as well. Because if you don't have money, you're going to be eating all the nasty foods. You're going to be eating at McDonald's. You're going to be eating all the nasty stuff. It doesn't take care of your mental health either. And this is where you got to understand, if you want to be financially fit, before you go out and start doing all the practical steps of how do you manage your money, you got to understand that if you just hate money, and you hate people who have money, and you hate this idea of becoming wealthy, you will never become wealthy yourself. How can you go out and do something that you hate? Because at the end of the day, we want to be happy with ourselves. And even if it feels like you're doing something wrong, if you thought you were doing something wrong, you probably wouldn't do it. You try to do things that are good. You try to do things that you think are right. And if you think making money is bad, if you think becoming wealthy is bad, if you think being rich is bad, you're not going to want to do that. And this is where now you have to understand. Your goal is to become financially fit, along with everything here. I'm going to focus on the financial side. But if your goal is to become financially fit, you have to want to do that. That means you have to think that it's a good thing. And if you think it's a good thing now, you can start reframing the way you look at money and then start reframing the way you look at how do you manage money. You start reframing the way you look at investing your money. You start reframing the way you look at earning money. And this is going to allow you the opportunity to then go out and actually build your wealth, because money is just one aspect of your lives. But it's an important aspect of your lives, because now if you have money, it gives you the opportunity to live a much more fulfilled and purposeful life, because you have the money to do the things that you want, but that means you have to actually want to become wealthy in the first place. This is the emotional and mental side of money. Once you understand this, now we can go into the practical side of money. How do you actually take the money that you have and turn your finances around and build your wealth or become a millionaire or hit whatever financial goals that you have? So let's talk about that. Now, to really understand the practical side of money, let me give you a little example. Let's assume that you're on this ship right here. For my male followers, I'm going to draw you a mustache, or as we like to call it, my native language Punjabi, a gut. And for my female followers, I'm going to draw you a braid, or as we like to call it in Punjabi, a gut. You are on this ship right here and you want to go to this island right here. And so what most people do is when they're on this ship and they want to get to this island, they say, we got to row faster. We got to figure out how we can get here as fast as possible. And you just keep putting in all this effort to keep rowing and rowing and rowing. But the problem that most people have in this situation when it comes to money is you have these holes in your boat. So now you keep trying to row faster and faster and faster, but you're not really making any progress. And the reason why is because water keeps getting into your ship. And when you keep trying to get there faster and faster and faster, you keep rowing the boat, you're not making any progress because you haven't figured out how to stop the sinking. You're spending all of your time and effort just trying to throw this water out of the boat, trying to make any progress, and you're spending all this energy, all this time, all this effort trying to do that while making no progress. And this is where what you need to do first is you got to stop the financial bleeding. You got to seal these holes in the boat, because if you spend a little bit of time trying to seal these holes in the boat, well, now when you start rowing, you're going to start making progress, and you're going to see that it's going to get easier and easier and easier to get to the island as you start to pick up momentum and steam. But if you're just trying to go against the current and you're constantly trying to throw the water out of the boat, you're never going to make any progress. So how do you stop the financial bleeding? Well, this is where you got to take a look at finances and see if you have things like high interest credit card debt. This is where you got to stop the financial bleeding first, because a high interest credit card debt is costing you 15, 20, 25% a year in interest. And when you're paying all this money in interest to your credit card company or to the payday loan company or to the buy now, pay later company that you bought things but then you didn't pay it off in time, or to the 0% APR company that you got this 0% APR debt but didn't pay it off in time, now you're paying 15, 20, 25% in interest. This is the money you got to pay back first. And you want to pay this back as fast as possible, because many people assume that if I want to become wealthy, I should just start putting money into my 401k, into my IRA, I should put money into the stock market and do all these things. Well, the reality is when you put your money into the stock market, you're trying to get a 7 to 10% return on your money. This has been the historical stock market return over the last century. But when you have these high interest debts, you are paying 15 to 25% a year in interest. So what I want you to do first is pay down this, because this is a bigger number than this. So you got to take this high interest debt and you got to get aggressive to stop the financial bleeding, to stop the water from leaving the boat. And that means you got to take a little step back from your investments and pay this off as fast as possible, because these high interest debts are skinning you alive. You should not be worrying about investing your money if you have credit card debt, if you have this buy now, pay later debt, if you have these payday loans you got to pay off, if you have these high interest debts, you should not be trying to invest your money. Right now, you got to pay this off as fast as possible. Once you do that, this is where now, in addition, I want you to go out and save your first $2,000. Right now, the majority of Americans do not have $1,000 saved up for an emergency. And if you look back for the last number of decades, every financial planner would talk about how you need to save your first $1,000. Well, what we've been seeing happen, especially over the last few years, is that inflation has made things much more expensive. And so now, if you want to be able to have a little bit of a financial cushion to save you and protect you against little financial emergencies, you got to have at least $2,000 saved up. Now, the goal isn't to just save $2,000, but I need you to go out and save $2,000 as fast as possible. This is your first step. You got to build your financial base. If you talk about how do you now stop the ship from sinking, how do you actually start making some progress, this is what you got to do. You got to pay down the high interest debts, and you got to save this first $2,000 as fast as possible. That way, then you can actually start rowing and start accelerating. But until you do this, you're never going to ever be able to become wealthy. So how do you actually make this happen? How do you pay down your high interest debts? How do you save your first $2,000? That means number one, you got to stop spending money. That might mean you got to cut back on Starbucks. That might mean you got to cut back on those monthly massage memberships. That might mean you got to cut down on whatever car that is that you're driving. If you're driving a BMW, but you have high interest debts or you don't have $2,000 saved up, you have a problem. You want to sell that car and go get a used car that you can afford with cash that doesn't take the premium gas. And that means now you got to cut back on your lifestyle. You got to stop some of the spending. You got to turn down some of the vacations. You got to turn down some of the spending. You got to turn down the club on Friday, and you got to turn down Benihanas. And the reason why this is so difficult isn't just the math problem of, okay, I got to spend less money. It's the emotional problem of, wait, what do you mean you don't want to go out with me on Friday? Wait, what do you mean you don't want to come to my bachelor party? Wait, what do you mean that you're not going to be able to come to my wedding? And these are now the questions that people are going to look at you like you lost your mind. When they see you go from a BMW to a Toyota Corolla, people will look at you like you're the crazy one, like you're having financial problems, like you're the one that's having issues because you're not going to the Bahamas. But in reality now, what you're actually doing is you're actually trying to build your wealth instead of trying to stay broke like you were before. And ironically, when you were spending all this money, people thought that you were balling out, that you had all this money. But now as you start to cut back, as you start to actually build your wealth, now people look at you like you're the broke one. But this is where now it's important for you to understand that you got to understand the mindset side. Your goal is to become wealthy. And part of this means you got to understand the math part of becoming wealthy. And the other part is you got to be able to handle the criticism and remember why you're doing this. You're doing this so you can have real financial freedom. My goal is not for you to cut back on your lifestyle that way you can never enjoy your money. My goal is for you to buy whatever the heck you want, but be able to afford it and not have to worry about the price. But in order for you to get there, you got to go through this period of sacrifice. I call it the decade of sacrifice, where you're going to have to go through this period of spending less and earning more. That way you have more money to invest, because the reality is, if you keep spending all your money, you're going to make everybody else rich at your expense. Because when you're going out and you're spending your money at your banker, when you're spending your money on your credit card, when you're spending your money at BMW, when you're spending your money at Gucci, you're making all of these companies rich. But the one entity, that one person that does not become rich when you're going out and driving a BMW, when you're wearing the Gucci, when you're having all the nice things, is you. You are the one that is not rich because you're making everybody else rich. And this is where you got to flip the script. You want to make yourself rich before you make everybody else rich. Which brings me now to the second thing that you want to do, is you want to create some sort of system for your money. What every single wealthy person has in common is when they earn money, they know exactly out of this new $100, $1,000, $1 million that they generate, how much of this money can be spent, how much of this money is going to be invested, and how much of this money is going to be saved. They don't leave this up to question and just wonder what's going to happen with their money. What the majority of everybody else does, what the majority of broke people do, is they make money, they spend their money, and then they wonder where all their money went. And this is where you got to start changing the way that you use your money. That means that from now on, every dollar that you earn has to go through a funnel. And a simple funnel that you can follow is something like a 75, 15, 10 plan, which says that for every dollar that you earn from now on, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now what you're doing is, no matter how much money you earn from here on out, you're always going to be paying yourself first. What does it mean to pay yourself first? That means you are going to invest and save some of this money before you go out and spend all this money. Because what ends up happening to a lot of people is you make $100, you feel like you can go out and spend $100. And when you have this mindset of, I made 100 so I can spend 100, I made 1,000 so I can spend 1,000, you're always going to be stuck in this game where you're just constantly trying to spin your wheels and working harder to make more money, to drive a faster car, but you can never actually get ahead. And this is where you got to stop that by taking a little step back. And that means now you got to invest and save your money before you spend all your money, because what you're going to be able to do is, when you do this correctly, you're going to be able to use your investments to make you more money. Now, these investments are not going to make you a ton of money tomorrow, but it takes time for this money to grow and compound and actually generate you a return. But once it starts doing that, now you're going to start to have more money coming in. That's going to allow you to have more of the nicer things, and you don't have to worry about the price, because this is money that you're generating without having to go to work to get paid. Your investments pay you in a way that your money is making your money. This money that you're generating from your job or your business, you got to work to get this money. So if you're working to get this money and then you're spending all this money on dumb stuff, and I'm going to call everything dumb stuff, your car, your home, your vacations, all that's dumb stuff. But if you're working hard to buy the dumb stuff, well, you're working hard to make everybody else rich. But if you're working hard to buy the assets, and then your assets, your investments are paying for your dumb stuff, well, now it's that easy earned money that's buying you that dumb stuff. Now it doesn't feel so bad to go out and buy the dumb stuff because you don't have to work hard to get it. You got to work hard to get this money in the first place. Use this money to make yourself rich first with these investments, and then use your investments to buy the dumb stuff. I want you to have whatever dumb stuff that you want. Nothing wrong with having the dumb stuff, but when you're working hard to just buy dumb stuff, you're never going to actually build any true wealth. So when you do that, you're making everybody else rich. And that's why you want to create some sort of system where now you are not spending all of your money. Now, what I do recommend is to create 3 different bank accounts. And many banks will allow you to do this for free, where now anytime you get paid, money hits your checkings account right here. Then when money hits your checkings account, some of this money automatically can go into a different account where you hold your investing money, and some of this money goes into a different account that holds your savings money. This way now, your money is separated, and you cannot accidentally spend your investment money on a new Gucci belt. You cannot accidentally spend your savings money on a new TV. This way you have a little bit of differentiation and you can't see all this money here. So you want to create this real system now where some of your money is going to be put aside for investments, some of this money is going to be put aside for your savings. The more money you invest, the wealthier you'll become. Your savings are not there to make you wealthy. Your savings are there to protect you against an emergency. Now you don't need to save your money forever. You want to save somewhere between 3 to 12 months worth of expenses. And the amount of money that you save is going to depend on you, your risk tolerance, and where you are in your financial goals. If you're 22 years old, and you don't have any financial responsibilities, well, you don't need that much of savings because you can be more aggressive. You can be more aggressive with your investments and you can take more risks. So if you're 22, you don't got any financial responsibilities, you need very little savings. But now if you're 45 years old, you got kids, you got a spouse you got to take care of, maybe you're taking care of your parents, you're a little bit less ability to take risk, then maybe you save some more money. So depending on where you are in your financial situation, depending on your risk tolerance, depending on kind of what type of needs you have, that's how you decide how much money you save. Once you hit your savings goals, that's when you reallocate the saving money to your investments. Because again, your investments are what is going to actually make you wealthy. Now, where can you invest your money? The 3 places, the 3 asset classes that have built more wealth than any other asset class over the last century are stocks, real estate, and businesses. Stocks give you the ability to go out and invest in the companies that make this country. You can go out and invest in some of the biggest companies in the world, and even if you don't want to invest in the individual company, you can invest in funds that give you exposure to the entire economy. You can invest in funds that give you exposure to the total stock market. You can invest in funds that give you exposure to the S&P 500. That's a group of the largest 500 companies in the stock market. You can invest in funds that give you exposure to technology. You can invest in funds that give you exposure to healthcare. You can invest in funds that will give you exposure to international companies. You can invest in funds that will give you exposure to dividend-paying companies. So now, if you want to invest in stocks, that's the most accessible way to go. You can start by investing as little as $100. But the key here is you want to keep consistently investing, because most people, they assume that if I want to put my money in the stock market, I got to go and find the next Google, I got to find the next Amazon, I got to find the next Apple, and I got to throw my money into that. Well, when you do that, you're taking on the most risk because number 1, you might not know how to do the research. Number 2, you're trying to find the next hot stock. And number 3, if you invest in a bad company, you can lose all of your money. And this is where now, if you don't want to be involved in listening to the earnings calls and keeping up with the company and trying to understand the company and monitor investments, instead of investing in individual companies, you can just invest in funds. A few examples of these funds are ETFs, index funds, and mutual funds. And again, there are funds that give you exposure to really anything. And now if you invest in this one fund, you can get exposure to a whole basket of stocks. And now all you got to do is keep funding it. Every time you get paid, you put some more money into your fund. Every week, every 2 weeks, and every month, you just keep putting more money into this fund. And this is where people get confused because they think, well, what happens if the market's going to crash? What happens if we see a recession? What happens if we see the stock market go down? All you do is buy more. Because what we've seen over the last century is that despite the recessions, despite the market crashes, if you just keep buying, you will be able to build more wealth. Because our economy has gone through cycles. In fact, our United States economy has gone through a recession pretty much every decade for the last century. So if we go through recessions, if we go through market crashes, all you need to do is keep investing. Instead of being the person that panics and sells and loses money, be the person that keeps consistently investing. You stay calm when everyone's running around with their heads cut off. Everyone's talking about how the world's going to end. Everyone's talking about how the stock market will never rise again. You just keep calmly buying and accumulating more shares because this gives you the ability to buy even more at a discounted price. That's why wealthy people love recessions, because it gives them the ability to build more wealth even quicker. So you build a system that allows you to do that. If you want to be more involved, you can invest in individual companies. If you want to be more involved, you can invest in something like real estate. Real estate gives investors three big benefits. You get cash flow because now if you go out and buy a rental property like a home or an apartment complex, you buy this property for the ability to generate cash flow. The tenants pay rent, and this rent should cover all of your expenses, your property taxes, your insurance, your maintenance, your management fees, your vacancy costs, and your mortgage if you have any, and then put some money in your pocket. If you do it correctly, that is what real estate is supposed to do. But in addition to the cash flow, you also get tax breaks. As an attorney who's not your attorney, I can tell you that real estate has some of the biggest invest tax breaks that our tax code has to offer. And number three, you also own a hard asset, because when you own real estate, you own something that you can see, feel, and touch. You can see the bricks, you can see the windows, you can see the doors. So you have this thing that you can see, feel, and touch versus when you own a share of the Amazon stock. You own a piece of paper that says you own some of Amazon, but you don't actually own any of the Amazon machinery. You just own a piece of paper that says you're entitled to some of the ownership. So you get those benefits with real estate. Then with number three, with businesses, this one is the most involved. You can go out and actually create your own business, which gives you unlimited earning potential, but that takes the most work, the most time, the most risk, and the most effort. Now, there's also a chance that you'll fail. In fact, most startup businesses fail. If you don't want to go out and start your own business, you can also invest in other people's businesses. But again, very risky. Most startups will fail. Most of your startup investments will fail. However, if you can hit a good startup investment, if you can hit a good business investment, that will give you the opportunity to make a lot more money. However, this one, investing in other businesses, is generally reserved for people who have more access to capital because of just how much money it takes for you to get started as a venture capital investor or an angel investor. So just understand that there are different ways for you to invest your money. But the three avenues that have built the most wealth out of any other asset class are stocks, real estate, and business. And I should also mention that it doesn't really take a lot of money to start your own business, but it takes a lot of work and effort. You don't need money to make the money, but you need money to grow your money. Once you build the system of how you want to use your money, that we're always investing your money and saving your money before you go out and spend all your money, you also want to make sure you can control the spending money, because if you go back into the same bad spending habits that you had before, well, you can never out-earn bad spending habits. So a few things that I want you to remember here when it comes to spending is do not finance anything that's not putting money in your pocket, the only exception being your home. So when it comes to you going out and buying a car, you buying your phone, you buying your electronics, your groceries, stop financing the stuff, even if it's 0% APR. And everybody says, well, if instead of me paying $1,000 for my phone, I can just pay $50 a month, I can invest that difference and have more money in my pocket. Sure, in theory that makes sense, but what ends up happening with most people is now you go out and you finance this phone, you're only paying $50 a month, and then you go out and you finance this sofa, you're paying $75 a month, you go out and you finance your car, you go out and finance more things, and now you go out and spend more money than you would have if you had to buy it with cash, because you don't actually feel the pain of this money leaving your account. That's why 0% APR, buy now, pay later, or as I like to call it, broke now, broke later, are so profitable for businesses and banks, because they know that you are going to go out and spend way more money when you do this 0% APR or buy now, pay later. So when it comes to you actually spending money, you got to shut down these expenses. That means you got to actually buy what you can afford. And that means number one, stop financing things that don't pay you. And number two, if you're actually going to buy something, make sure that you can actually afford it, not just buy it. One of the rules that I like to follow is a rule of 5, which says if I can't buy 5 of them, I can't afford one of them. Now, you can apply this rule to different aspects of your life to see however it is that you want to spend your money, but the key here is if you have $100 in your account and you spend all $100, well, you're going to constantly be broke like that, and you want to make sure that you have money. You want to be able to spend within your means, and understanding that number one, you can only spend this money, but now out of this money, how much should you spend on one item? How much should you actually be able to afford? Because if you have $1,000 in your account and you want to buy a $1,000 handbag, you're spending all of your money to buy a handbag. I wouldn't do that. And this is where you got to understand how to control your spending. And then if you have low interest debts, if you have things like a mortgage, if you have things like a car note, this is where you can also decide if it's worthwhile for you to pay down these debts or continue investing your money. And this question is really going to depend on you, because if you are somebody who wants to live big, you want to fly around in first class, you want to fly in private jets, you want to have the fancy vacations, if you're just working to pay down your 5% mortgage or your 6% car payment, you're never going to be able to really grow like that. You're going to have to work to earn more money, and you're going to have to be more aggressive with your money. But if your goal is just to be financially free, you never want to have to stress about money, never want to have to worry about money ever again, well, then you can also consider, instead of just investing your money into the markets, to just pay down some of this debt, because when you have no expenses, you're also going to be able to be a lot more financially free. So to answer that question, it's going to depend on where you are and your personal interests and goals and risk tolerance and investing education. But just understand that you paying down these debts is another form of investing. Now, once you understand this, once you know how to spend your money, this is where you want to add some more fuel to the fire. Now, the question is, how can you earn more money? That way you can amplify this machine. And the reason why I'm talking about earning more money here is because, like I said just a minute ago, you cannot out-earn bad money habits. And the thing that most people try to do is when they realize, oh, I'm broke, I need to figure out my money, I need to invest more money, I need to go and get more money. And when people make more money, statistically, what we've seen happen is that the majority of people end up in a bigger financial hole. Why? Because they don't know how to do this. And so then what happens is you get a raise, you get a promotion, you get a bonus, now you go on a trip to the Bahamas. You go and buy a new car. You go and upgrade your home. You go and upgrade your lifestyle, your spending, before you inflate your investments. And that's why you need to have some sort of system like this. That way now, as you earn more money, you're always investing more money. You're always saving more money before you just go out and spend more money. Now the question is, how do you earn this more money? And, well, there's a lot of ways to do this. You can do this from a job, see if you can get a raise, see if you can get a promotion, see if you can get a second job. Maybe you get a career change, maybe you get a certificate. You can figure out ways that you can earn more money from your career. But maybe that means you go out and create your own side hustle. Maybe you have a little bit of an entrepreneurial bug. You want to create your own business. You want to create your own income. Now, it's hard work, but it is possible. There are so many free resources out there, thank you, YouTube, that can teach you how to do that. Because now, when you're trying to figure out how do you 10x your income from 50 grand to $500,000 a year, well, that $500,000 a year is going to allow you to invest a lot more and save a lot more and get you to this wealth a whole lot faster. Because now you're making the money not just to drive a faster car and to have nicer things, you're making the money to have more investments. But the question is, how do you get there? Now, I can't tell you what to do. One of the dumbest and most annoying questions people ask me is, what business should I start? I don't know. I don't know what you're interested in. I don't know what your passions are. I don't know what you enjoy doing. I don't know what you're good at. I don't know what you're bad at. Find a problem. Once you figure out the problem, see how you can solve the problem and charge money to solve that problem for other people. The bigger the problem, the more the people will be willing to pay for it. The more difficult it is to solve the problem, the more the people will be able to pay for it. The bigger this need, the more the people will be willing to pay for it. But you have to be able to solve a problem and monetize that solution if you want to be able to make more money, especially if it's something that you create. But now as you make more money, you're going to have to ask that same question: what do you do with your profits? You take that profit and you invest it in the stock market, you take that profit and invest it back into your business. But I will save that question for a different video, because that's getting a little bit beyond what I want to talk about here. Once you do this now, you know how to save, you know how to invest, you know how to spend, you know how to earn more money. Now the question is, how do you protect your assets? And as an attorney who's not your attorney, I'm going to tell you this because, well, when people realize you have money, they're going to try to take their hands and put it in your pockets and grab some of that for themselves as well. And that means you want to surround yourself with good attorneys and good tax accountants and accountants to protect you. Because, well, people will try to sue you. People will try to come after you. People will try to do a whole lot of things to try to take some of your money for themselves. So the best thing for you to do right now is you got to figure out how you can find a good attorney. Now, you want attorneys to protect you if you have businesses, to create legal entities, legal sheets, health insurance, but you also want to have your tax advisors and financial advisors, because, well, as you make more money, your tax liabilities can also go through the roof. And you want to make sure that you have a good tax advisor, not just a tax advisor, a good tax advisor, because there's a very big difference. I learned this the hard way. There's a very big difference between a good tax advisor and a bad tax advisor. And if you have a bad tax advisor, they might be cheaper to file your taxes, but they're going to end up costing you way more in your mental capacity, in your stress, and also way more in how much money you have to pay in taxes. So it pays, as you start to earn more money, as you start to build this wealth, to go out and find a good tax advisor for yourself. Now, in the beginning of this video, I told you that if you stuck with me until the end, I'm going to show you how you can get a copy of this ebook, How to Build Wealth as an Investor, for free. In this ebook, we go over the things that we talked about today and even more, starting with how do you build the mindset of an investor, to how do you start saving your money and building that financial foundation, to investing your money. How do you generate cash flow? What are the different investing strategies that you can have? How do you spend your money smartly? How do you earn more money? And how do you protect your assets? There's a ton of value in this ebook. If you want to get a copy of this ebook for free, all you got to do, I got the link for you down in the description below, or go to briefs.co/ebook and you can get a copy of this ebook for yourself. And if you enjoyed this video, please share it with a friend. That's one of the best forms of a thank you. I appreciate you watching. Most people assume that being broke is generational, but it doesn't have to be that way. Now, I know I didn't go to medical school, sorry mom and dad, but last I checked, there's no DNA sequence that says how big your bank account is gonna be. Congratulations, you're having a girl, millionaire. The reason why being broke ends up looking generational is because when you grow up seeing your parents struggle with money, and when you grow up hearing your parents say, we can't afford nice things, we can never be rich, and somebody like me can never succeed in this world, how do you think you're gonna approach money when you're 30 years old? Or maybe even more importantly, how do you think your kids are gonna see you approach money? Hey son, I know I'm a bad influence when it comes to money, but don't listen to what I do. Just watch some random guy on YouTube. For most people, you're gonna end up passing that same financial miseducation to your kids. They're gonna see you struggle with money. They're gonna see you say that you can't become successful. They're gonna hear you say that you can't become rich. They're gonna hear you say that you can't afford nice things. And they're gonna absorb the exact same thing that you did. Now you can start to see why this pattern ends up becoming generational, but this is where it's up to you to break this cycle of being broke. This is why the first step to you becoming wealthy and breaking out of the cycle of living paycheck to paycheck, being broke, living in poverty, isn't to go out and ask for a raise, although that can help. It's to change the way that you think about money. Plus, what we have seen statistically is that when people go out and earn more money without understanding what to do with that money, they are more likely to go out and spend more money and end up in a bigger financial hole than they were before. The first thing that you have to do if you want to become wealthy and break out of this cycle is you have to believe three things. You have to believe, number one, money is a tool. You have to believe, number two, that money is abundant. And you have to believe, number three, that I will become wealthy. And by I don't mean me, I mean I as in you. Now, I already know some of you are watching this getting ready to tell you something like, Jaspreet, this is cool and all, but what does my mindset have to do with anything? Just tell me what to do with my money. And what you need to understand is if you don't understand and believe this, it is going to be impossible for you to become wealthy. You can learn everything about investing. You can learn everything about financial education. You can learn everything about how to use your money smartly. But if you don't believe this, it is going to be impossible for you to become wealthy. So let's start by talking about how money is a tool. The reason why you have to understand this is because there's a lot of emotion around this topic of money, that money's bad, money's taboo, money's evil, money is this negative and bad thing. But you got to understand money is a tool. Is a hammer good or bad? Well, a hammer is just a hammer. Money is just a tool. It's not good, it's not bad, it is just a tool. It amplifies who you are. If you wanted to nail a nail into a piece of wood, a hammer will help you with that. Money is a tool that will help you eat. Money is a tool that will help you pay your rent. Money is a tool that will help you buy investments. Money is a tool that will help you buy vacations. Money is a tool that amplifies who you are. It doesn't make you a good person. It doesn't make you a bad person. It amplifies who you are. And you have to stop giving this negative association to money and people who have money and understand now that money is just a tool. There are good people in the world. There are bad people in the world. We need more good people with money. Money doesn't make you good. Money doesn't make you bad. It just amplifies who you are, and we need more good people with money and understand money itself is just a tool. It's just paper. It doesn't have any emotion, which is why you got to go out and get that money. Number two is that money is abundant. A lot of people get into this mindset of thinking if I make money, then you can't make money. Or if you make money, then somebody else can't make money. But there's a lot of money in the world. Now, if you watched any of my videos, you've probably heard me talk about what's going on in the economy in some way, shape, or form. And if you have, you understand that there's a lot of money in the world. Not just that, our central bank in the United States, the Federal Reserve Bank, is printing tons of money. They have printed trillions and trillions and trillions of dollars over the years. Well, if there's that much money in the world, all you need is a small little sliver of all this money that's out there in circulation to build that wealth for yourself. And this is where you have to break out of the mindset of thinking that either I can win or you can win. It is this game of thinking that if I give money to somebody else, they win, I lose. When what you need to be thinking about is, if I give somebody else money, what value do I get in return? If I give you $100, can I get $200 worth of value back? And once you start thinking like this, when you think in terms of value as opposed to price, it is going to allow you to actually invest in yourself and find more opportunities in the world, because when you live in this scarcity mindset that there's only a limited amount of money in the world, that I can't actually go out and attract more money, that I can't actually get more money, you're going to hold on to your money very tight and you're never going to be able to see those opportunities around you. And number three is you got to believe that you're going to become wealthy. Because if you don't believe that you can become wealthy, it's going to be impossible for you to actually do so. If you believe that somebody like you, somebody that looks like you, somebody that grew up in your background, somebody that grew up the way you did, can't become wealthy, well, you can learn all the financial education, but when it comes time to actually take an action, you're going to sabotage yourself because in the back of your mind, you don't believe that you can become wealthy. And if you don't believe that you can become wealthy, you're going to take actions that will prove that you don't believe that you can become wealthy, which is why you have to start changing the way that you think. Now, if this is something that you're struggling with, go out, watch YouTube videos on personal development. Go out and listen to podcasts on self-development. Go out and read books on personal development and self-development and invest in this first because you have to change the way that you think. And if you have this broke way of thinking, if you have this scarcity way of thinking, if you have this negative self-sabotage way of thinking, it is going to be impossible for you to succeed. And I can tell you that you can succeed, but you have to stop being your own roadblock. It's not going to be easy, but you can't be your own roadblock. The rest of the world is going to try to be this roadblock for you, but you can't be that roadblock for yourself, which is why you have to invest in your own education, your own self-development, your own personal development, and then start worrying about, okay, how could I now start taking the practical steps to be smarter with my money, to build wealth, and start investing my money? Which, let's start talking about that. And I do want to let you know that for those of you who do like the idea of staying up to date of what's happening in the financial news, well, my team at Briefs Media puts together an amazing newsletter every day called Market Briefs. Market Briefs is a 5-minute recap of what's happening in the stock market, the housing market, the crypto market, the global economy, and our own economy here in the United States. You can read it in just a few minutes every morning, and I promise you, you're going to love Market Briefs. And if you don't, well, you can unsubscribe at any time because it's completely free. So if you'd like to join Market Briefs for free, all you gotta do is click the link down in the description below or go to briefs.co/market. That way you can start getting your own briefs as well. Now, as you're working to change the way that you think, this is where now you gotta change what you do with your money. And the very first thing that you gotta do if you wanna start breaking out of this cycle of living paycheck to paycheck, the very first thing that you gotta do now with your money is you gotta go out and save $2,000 as fast as possible. If you do not have $2,000 sitting aside in a bank account that's there to protect you against an emergency, this is not money you're supposed to use as a down payment as a car. This is not money you're supposed to use on a new rental property or to buy a home. This is not money you're supposed to use when Amazon has a deal going on. This is money to protect you against an emergency. If you do not have $2,000 saved up, the very first thing you got to do is go out and save $2,000 as fast as possible. And when I say as fast as possible, I mean you got to cut back on anything and everything until you can get this $2,000, because if you don't have $2,000 saved up, you are in a financial danger zone. Any little thing can tip you over the edge and put you deeper into credit card debt. And once you start getting into credit card debt, it is very difficult to get out. And this is where right now you got to go out and save these $2,000 as fast as possible and put this money aside into a savings account that you don't touch unless there's an emergency. And so now you got to cut back, work to earn more, do whatever you got to do. And the goal is to save that $2,000. Once you save that $2,000, the next thing you got to do is you got to break out of credit card debt. That means you got to pay off all of your credit card debt or any other high interest debts that you might have. Things like payday loans, things like your high interest rate loans that you've taken out. You got to pay this off aggressively before you start worrying about investing your money to the stock market. Before you start worrying about should I buy a home, before you start worrying about all that other stuff, you got to pay off this credit card debt and these other high interest debts, because these are things that are skinning you alive financially. These are things where you're making everybody else rich. When you're paying 20% in interest to your credit card company, guess what? You're the reason your credit card company has that beautiful office. You're the reason that the credit card company gets to fly around in private jets. You're the reason the credit card company is giving amazing perks to everybody else, including people like me, because I love using my credit card, but I refuse to have any credit card debt. And this is where now you got to understand, you got to stop making other people rich. And you got to get out of your credit card debt. And this is where now you got to be extremely aggressive. What I like to say is, until you do this, until you have these two things, you should not be worried about spending money. You should not be worried about what car you drive. And you should not be worried about having a Netflix subscription as well. And you might say, wait, Jaspreet, what the heck are you talking about? Netflix is only like $15 a month. What do you mean I can't have a Netflix subscription? Well, the purpose for this isn't so you save $15 a month. It's so you save 2 hours of your time every single day. Because if you don't have these two things figured out, you are in a financial danger zone. And if you are in this financial danger zone, Well, a little thing can push you over the edge and it can make your financial situation significantly worse. And this is where I need you to use these 2 hours a day to invest in your learning. Take classes, read books, do things to invest in your financial education. If you don't have the money to spend, then watch free content on YouTube. Listen to podcasts. Rent books from your library. Go do something where you can invest in your financial education, learn how you can earn more money, learn how you can pay down your credit card debt, and figure out how you can cut back on your expenses, because until you have $2,000 saved up and until you no longer have any credit card debt, you are going to be stuck in your financial situation and you're never going to be able to get ahead financially. Now, I have tons of videos on my channel where I talk about how do you invest your money, how do you figure out a system of how do you put your money to work, how do you passively invest and actively invest. I don't want to go over that in this video because right now, if you are living paycheck to paycheck, this is where you got to start. You got to start by now changing the way that you think, and then you got to save your first $2,000, and then you got to pay down your credit card debt. Start here. These are the first things that you got to do. Once you understand this, now you have the ability and the breathing room to actually go out and do things to make yourself rich. But in order for you to actually make yourself rich, you got to stop the financial bleeding, and that means you got to stop giving all your money to everybody else, which means you got to save the $2,000, you got to pay off the credit card debt, and you got to change the way that you think about money too. But you also have more risk. You're not guaranteed to make money in the stock market or with real estate. Sometimes the markets will go up, sometimes they will go down. You're not guaranteed to make 10%. Sometimes it's going to be higher, sometimes it's going to be lower. So more speed, more risk. And when you come down here to the business where you have the most potential speed, you also have the most risk. The key is you need to